We have a great show of Retiring Well coming up. We're going to be talking to you about fees and commissions and how those impact your overall retirement plan. Safe withdrawal rates. What does that look like for you in retirement? The need for life insurance and how life insurance can play a role for you in your overall retirement plan. And market fundamentals. You want to stay tuned for a great analogy on how that works. So stay tuned to Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, in this segment, I want to talk about fees. Listen, understanding how your advisor is getting paid is very, very important. Now, we actually have the tools to take any portfolio, get behind it, and show you exactly what you're paying in fees. But I just want to speak to it because those fees can take different shapes and forms. So, for the most part, if you're dealing with an insurance product, whether that be an annuity or be life insurance and the like, most insurance companies pay the advisor a commission. Okay, and they usually get a bigger commission if that annuity is of a longer period of time. Okay, in life insurance, it's usually a percentage of the first year premium. But typically, when you're dealing with an annuity or life insurance or an insurance product, the advisor is getting a commission. There's usually no charge to the client in that environment, no fee to the client. So that can be a good thing. Another way insurance companies can charge is when they have these annuity products. Sometimes they'll come with these riders, whether it be a guaranteed death benefit that's going to be there in case something happens, or a guaranteed income stream that's going to be there. And usually they call these riders because there's additional benefits associated with a contract. And there's typically a rider fee that the insurance company charges. Now, in this particular case, unlike the commissions, that fee is getting charged to you because if there's an investment side to that thing, there's usually that fee is coming off that investment side. So knowing if there's any of those kind of rider fees is going to be important to know. Mutual funds have fees. They have what they call expense ratios. That's the general administrative and research costs that they're having to pay to run that mutual fund, and they pass those costs on to you, and basically it just comes out of the performance. Now that expense ratio, what they're charging you, has to be disclosed in the prospectus. So if you get that annual prospectus from that mutual fund, you can go in there and find out exactly how much you're paying in that fees that's just coming out of your performance. Now, if you have assets under management, this is where a portfolio is actually being managed by an investment company advisor. Typically, how you get charged in that kind of environment is there's a percentage that they charge you on the balance of what's in those accounts. They call it assets under management. Typically, you'll see anywhere from 1%, sometimes up 1.5%. Now, where your funds are held, that's typically with a custodian. You want a custodial relationship because you want that custodian reporting to you everything going on in the account. Okay. In the past, we saw a lot more custodians charging a fee for the trades that were under those accounts. Today, because of competition, a lot of these custodians are now not charging any trading fees. Now, they'll charge you a fee when you exit maybe a qualified account because they have to do a 1099 at the end of the year, but for the most part, no fee. So hopefully you found that valuable. But again, understanding how you're getting charged and what you're paying, very, very important.
Really great information that Larry shared there, and it's so important to understand what the fees and the commissions might be for whatever different types of accounts you're structuring. And so with that, if maybe you have an investment that's in the market, there's likely going to be different advisory fees that are charged for that. And so it's one where you want to know what those costs are. On the other side of the business, if you're dealing with, say, different types of annuities or life insurance, something to do with life insurance companies, then they're typically going to charge you a commission, or the advisor is getting paid a commission. And so in our opinion here at Centennial Wealth Advisory, we believe it's typically one or the other. So if you're working with annuities, there's typically going to be a commission versus if it's in an investment account, then there's an advisory fee. So again, we feel like it should be one or the other, not both. And so that's something that you want to be paying close attention to. And ultimately, Jack, you want to be talking to your advisor, better understanding what those costs are.
Well, exactly. I really like the transparency that we're able to provide. We have tools where we can get in and dig behind any investment and, identify two things that I think are really important to you. What is your risk and what are your fees? After you establish what the risks are and what the fees are, then you can better understand if you like how you're positioned. You might be able to learn what else is out there. Because ultimately, I think it's important to know what are you getting in return for those fees and what are you getting in return from the different help that you're really looking for. And so if you have any questions about how you're positioned, what your risk might be, what your fees might be, if you have any questions on the transparency, give us a call. Let us know. We can dive into that, and no obligation first meeting to help you understand how you're currently positioned.
Yeah, it's so true. Like Jack was talking about, what are those additional services that you might be provided? And so whether that's maybe diving into what your income plan is, or the risk reward of your different investments, maybe it comes down to different estate planning or different insurance needs that you have, and really looking at all those different areas that fit into your retirement plan. So stay tuned, as we're going to be diving into safe withdrawal rates and the need for life insurance.
Centennial Wealth Advisory is a proud sponsor of the Traverse City St. Francis Gladiators football team.
Professional quarterbacks have a game plan. Passing the ball with power and accuracy is vital, and good communication within the team is key. As you can see, we aren't professional quarterbacks, but at Northern Michigan's Centennial Wealth Advisory, we are professional financial advisors. And just like a good quarterback, we have a game plan, a holistic approach for your financial future. Using income planning, tax planning, estate planning, wealth management, and healthcare planning to help you plan to retire well. We have lived in Northern Michigan all our lives, and we have offices in Traverse City, Gaylord, Petoskey, and Cadillac. Give Centennial Wealth Advisory a call or visit us at cen-wealth.com and let us help you plan to retire well.
I want to talk in this segment about what we call the safe withdrawal rate, okay? Now, what this is the concept is simply this. It's an amount or percentage of a portfolio that you can take from that is considered safe in the sense that you're not going to run out of money. You might even grow your principal a little bit over time. Okay, so it's not brain surgery, all right? If I got a portfolio that's making 5, 6, 7% on average, and I'm pulling 4, 5% out, maybe that's what I've deemed a safe withdrawal rate, then that works all day long, right? Because I got 5, 6, 7% pulling 4 or 5% out. That plan's going to work forever, right? Now, that's the concept, but you have to understand, you're going to want to make sure that you don't have any big losses in that picture. Remember, that concept only works if you're averaging that as a rate of return with no hiccups. Now, let me give you a case where this can be bad. Let's say I got a portfolio that's maybe, let's say just $500,000, just so we use a round number, and I'm pulling 5% off. So now I'm taking $25,000 a year for income, okay? As long as that portfolio continues to make 5% or more, I'm good, right? But what if we have like a 2008 and that portfolio drops to half its value? If I needed that $25,000 for income and now my account's only worth $250,000 and I'm pulling out $25,000, folks, you're now pulling out 10%. Now, how do I grow it back? I've got to get a better than 10% rate of return from here on out just to even start building that portfolio back up. So you want to understand that that concept works, but you're not going to have any big losses. It used to be that when you got close to retirement or in retirement, you were in what you call the preservation of wealth and income phase of your life. Most would just move from equities into fixed income accounts like bonds when they were paying, let's say, 5, 6, 7% or more. Today, the yield on bonds is so low, it's hard to make that move without having a mix of stocks in there. And of course, with stocks or equities, there's risk. So you want to be well diversified, you want to be positioned accordingly. Be careful of those income plans out there. There's a lot of income plans. All advisors have the tools. They'll tell you that you're never going to run out, but remember that one assumption is that rate of return they put in there, that growth rate is going to be consistent, and sometimes that doesn't happen. All right, remember in retirement, your number one enemy is going to be volatility, as I explained earlier. So be careful.
If you're retiring soon, it's likely you have many decisions ahead of you. One of the larger ones is Social Security. How are you going to take it? Are you going to take it early? Are you going to take it at your full retirement age, or maybe even delay it? Social Security needs to be viewed as an asset. If you live a long life, it's likely you can collect a large sum of money over time with those payments directed to you. How, though, folks misjudge Social Security commonly is how it's taxed. How are you going to pay tax on that for the rest of your life? And it's important to factor that in when to take it. And also paired with your other assets you may have, it may make great differences as well. If you don't have a Social Security tax plan built into your retirement, it's extremely important and could cost you thousands over your lifetime if done improperly. We would love to sit down with you here at Centennial Wealth Advisory and talk through what that looks like on a larger scale and see if we can help you have a successful retirement.
In this segment, I want to talk about life insurance. Now, when I was a young man, had not accumulated a lot of assets, I had 3 kids at home, and I was the sole breadwinner, I found having life insurance very, very important. But as I got older, as I acquired some assets, my kids are now grown up, they're having their own kids now. Did I find that life insurance was as valuable as it was when I was younger? Maybe not. But I want to give you some ideas where life insurance can be valuable in retirement planning, especially in the latter years. First of all, when it comes to life insurance, a lot of people will be paying this premium, and they'll come in and they'll say, Larry, I'm not seeing much value in maybe having this. I'm paying this premium. Maybe we could have that being going to something different, And what I'll ask them is simply this, what do you need that life insurance for? Is there any need for it at all? Because when you're looking at life insurance, you have to look at it like any other kind of insurance. I have house insurance in case my house goes on fire and I lose it, right? I'm going to want that contingency taken care of. I get long-term care insurance because if I fear I might go into a nursing home, I want to make sure I have the insurance for that. I have car insurance in case I have an accident. I have life insurance in case something happened to me. Does my family need any lump sum of money in any way? I want to assess it simply that way. If I have sufficient assets and I don't really need that anymore, then I would dare say we probably don't need to pay the premiums on it. There's some areas where you might need it. If maybe one of the spouses has a pension and is going to lose some of that pension amount, all or some, if something happened to that spouse, then, or maybe with Social Security you're going to lose the lesser of the two, having a lump sum to replace that income could be important in those latter years if we thought that could happen. We can use life insurance in an IRA exit strategy. Let's say I've got a big lump sum of IRA money, and I'm in such a tax bracket that I can't buy out Uncle Sam while we're both living. But what if that first spouse dies and the second spouse, the surviving spouse, has this lump sum money from life insurance that they can use to buy out Uncle Sam out of the IRA and then forever have tax-free income from then on? That could potentially be valuable. Again, any time I could see where I might need a lump sum of cash for any reason upon my death, then I'm going to want that life insurance. Now, you may not know this, but a lot of life insurance today, the death benefit can now be used for long-term care. So sometimes it might, if you still find life insurance valuable and you want it, you might be apt to maybe want to get some recent quotes because that death benefit can be used for that long-term care. Could be valuable. So hopefully this gives you some ideas where life insurance can be used in your retirement planning. Hopefully you found it valuable.
Hey, welcome back to another edition here of Retiring Well. I hope you found that information that Larry gave you valuable. It reminds me of some of the math concepts behind what it's like to go from your acquiring your retirement accounts to now like withdrawing from your retirement accounts. And one thing I was reminded there is how important the order of returns are. As you're accumulating and as you're saving, the order of your returns doesn't matter. If you had a loss of, let's say, 15% and then a gain of 20%, at the end of the day, it's the same. But as you transition into retirement, now if you take that loss first and take money out, now you have less money, you need a higher rate of return. Do you want to take more risk when you're in retirement in those withdrawal rates? And so as Larry was talking about, what's your risk of your portfolio? Because if you're all risk and you lose half of that portfolio value, now your withdrawal rate just increased way more than what the income plan that you might have had was illustrating.
Yeah, so true, Jack. Yeah, the idea of losing half your portfolio in retirement, that's a scary idea. So you want to make sure that you're structured appropriately. And same is true when you're talking about life insurance. And you may be in a situation where you're approaching retirement. Maybe you're fortunate enough where the house has been paid off. So maybe you're thinking, I may not have as great of a need for life insurance, but maybe you haven't considered the idea of having some tax-free money available upon your passing for a surviving spouse, or maybe for children, or leave to a charity, or whatever that might look like, that could really benefit them. But also today, there are a lot of different life insurance strategies that can also be utilized to help you in a case of a long-term care situation. Now, depending on the dollar amount, it may not be there to cover all of your expenses, but it can definitely be a tool that you might want to consider to have in your overall retirement plan. So if you have questions about any of these topics, we'd love the opportunity to sit down with you for a no cost, no obligation visit. So stay tuned as we're going to be diving into market fundamentals next.
Through the school programs in our local school district, kids receive physical therapy to work on their mobility skills, occupational therapy to work on their fine motor and handwriting skills, as well as speech therapy to work on their communication skills. And during the summer months, there's limited school therapy available, and the children are selected based on their severity of need. So there are a lot of children with maybe some more mild diagnoses that don't qualify for school therapy in the summer. Due to the limited therapist availability and insurance restrictions, and also the high out-of-pocket costs, Kids on the Go provides programming for the children that don't qualify for school therapy and also might not be able to afford or gain availability to outpatient therapy. So it helps provide services similar to what they'd receive in school, only it's in a group summer camp setting. Kids on the Go is the first of its kind in the entire Northern Michigan region, and we're excited to expand our healthcare resources. Kids on the Go is 100% donation-based, and 100% of the funding received for our Traverse City program goes towards supporting local children. And our program is run by local physical therapists, speech therapists, and occupational therapists in our region, and it's based in a local school right here in Traverse City. Kids on the Go is rewarding in that it helps us watch children progress and develop their skills over the summer. And to me personally, it's so inspiring to see them making progress with their mobility skills, their communication and speech skills, and being able to perform some functional things that they might not have been able to do in the past. We're just beginning our journey with Kids on the Go, but I have big dreams for this program. We're starting out small, and right now we have limited days that we're providing these services, but in the future I would love to include a greater age range of children in our programs and different types of programming. Maybe reaching out to different sports-specific programs like basketball, bike riding, swimming, different social skill groups for kids, hiking groups, sailing groups, and things that are really specific to our Northern Michigan community here that children can take part in and work together as a team. Well, we're very excited for any support from our local community, and we're thrilled to already have received a lot of generous support from different businesses and individuals in our community that have embraced our program. And we're excited for others to help join us and help build this amazing opportunity for children and families and help these kids achieve their goals and continue to make progress with their physical skills. Kids on the Go has a website, and that's www.kidsonthegocamptc.com, and all camp information and donations can be made through our website. Our camp registration opens January of each year online, and you can simply go to our website and log in there to register, or feel free to email myself or one of the other therapists if you have any specific questions about our programming. As a small and new nonprofit, we were able to pivot and move our services to an online platform where we were able to provide fun and safe therapy to a group of local children. I feel that it was really well received. I had a lot of positive comments from families that really enjoyed working together as a group from a virtual platform. And it also gave our therapists the tools to be able to work together and plan programming that we'll be able to build off of in future years.
Hi, welcome back. Now listen, in this segment, I want to talk about market fundamentals. There's a lot to listen to out there when you're listening to the news, and everybody has their own opinion, don't they? But for the most part, you have to understand markets are pretty predictable. They'll, for the most part, will trade at a multiple of its earnings. Now, I know there's volatility. There's times when, and we've seen it in recent months, where it dropped 3% in one day. That's not what I'm necessarily talking about. I'm just saying, as a general rule, markets will trade based on the underlying earnings of the corporations. And as a general rule, historically, it's traded around 16, 17 times earnings. That means if it's much higher than that, we're most likely in overvaluation territory, and it's done that historically in the past. So, you know, if it's just done it for quite a long time, that's something we're going to want to maybe be concerned about. If it's trading below that or well below it, some might argue that's maybe bargain territory, right? Good time to buy in. But for the most part, it's going to track pretty closely with earnings or a multiple of those earnings. So that's one fundamental we're going to want to pay great attention to if we're in overvaluation territory or we're in bargain territory, or if it's trading right within those fundamentals. Because if it's trading right within those fundamentals, and historically not above or below, and we're hearing a lot of bad news, is it something that we necessarily need to react to right away? It could be just a lot of emotions going on due to that bad news. Okay, so if you're a long-term investor, sticking to the fundamentals and understanding where the market's trading regarding maybe those earnings is going to be very important. Another thing to understand is when you're looking at fundamentals, you want to look at all the things that drive consumer spending, or what we call small business spending as well, because 87% of our GDP is basically small business consumer spending. So how those people are feeling about the economy, whether they're spending or not, is going to drive those earnings, which, as I just previously indicated, is then also going to drive the market. So we want to look at everything that's going to affect those earnings. For example, if we have low unemployment, why is that good? Well, it means if more people are working, they have more money in their pockets, and if they're feeling confident about the economy, they're going to spend that money, which is good for corporate earnings, again, which is good for the market. So confidence levels, how people are feeling, is something that we want to pay attention to. There's a lot that goes into market fundamentals, a lot of things we want to look at, but all the more reason you want to be talking to an advisor who's paying more attention to those kind of things. At Centennial Wealth, we do. So I encourage you, if you're at somebody and you just want to kind of see where you're at and how you're positioned relative to the market, then give us a call.
Market fundamentals are so important, and that's part of our daily routine, is paying attention to that, but it's also something that you want to be aware of and paying attention to with your overall retirement plan. Now, Jack here has a great analogy that I want him to share with you.
Yeah, so when I was coaching varsity football, one of the first things that we started with on the first day of practice was the fundamentals. And every single day in practice, we kept going over those fundamentals so that they were ingrained in each of our athletes. I think it's similar to what we do in investing, where we first have to analyze what the fundamentals are of the current situation. Going back to the football analogy, then each week we would then prepare and game plan based on the strengths and weaknesses of what we're up against. Well, that's very similar to what we do in investing, where if the fundamentals of the economy are strong, then maybe let's go take advantage of those areas. And if it's weak and if it's showing red flags, well, we want to be able to respond. And so that daily practice of first building out those fundamentals and then being able to react and game plan and put our clients in the best possible position is something that we do here at Centennial Wealth, and it's something that's very important for you to look at. So if you have questions with where your portfolio sits in comparison to where the market's at with all the different changing game plans that are out there, let us know.
Yeah, it's so true. And the other area that comes to my mind is then from a tax perspective. I think so often that's overlooked, or people are specifically just looking at the different investments and what sort of rate of return they can get, but they're not maybe paying attention to if they're building up their 401k or IRA that eventually is going to be heavily taxed. What are some ways to potentially start drawing that money or converting that money from a taxable position over to, say, a tax-free Roth IRA, and how beneficial that could be not only for their retirement plan, but if they were to leave that money behind to a loved one, the advantage from a tax perspective that could play. So again, as you're listening to the show and all these different topics that we share with you, we'd love that opportunity just to sit down with you for a no-cost, no-obligation visit and specifically look at your retirement plan and how we can help you plan to retire well. Thanks again for tuning in to Retiring Well.